Okay, I have a hypothetical for you. Imagine walking into your local town hall. Past the metal detectors, past the clerks, there is a slot machine sitting in the corner. And this machine, it pays out a jackpot between 40 and 60% of the time you pull the lever. How often are you going down there to play?
I'm camping out. I'm bringing a sleeping bag. I mean, those are better odds than blackjack. They are definitely better odds than the lottery.
Right. It sounds like a complete no-brainer. But here's the startling reality we're looking at today. That slot machine actually exists. It's the property tax appeal process. Depending on your ZIP code, appeals succeed 40 to 60% of the time. But, and here's the statistic that completely blew my mind in the research, only a 5% of homeowners actually bother to pull the lever.
It is a staggering efficiency gap. I mean,
Why?
you have a system where the odds are statistically in your favor, yet 95% of people just accept the bill they get in the mail. They just
Yeah.
assume it's like a divine decree. They pay it without question.
Exactly. And that is why we are doing this deep dive today. It's mid-February 2026. If you own a home, you know exactly what season it is. It's not spring cleaning, it's assessment season. Those notices are hitting mailboxes right now, or they're about to.
And this year, 2026, is a really critical year. If we look at the broader economic context from the source material, average property taxes have jumped 18% over the past 5 years. That is a massive increase in carrying costs for the average family.
It's huge, and we're dealing with this weird phenomenon that the sources call a pandemic hangover. Can we unpack that? Because frankly, the housing market feels a lot cooler now than it did a few years ago.
That's exactly the problem. Think about what happened to home prices in, 2021 and 2022? They just spiked. Bidding wars, waived inspections, absolute chaos. But property tax assessments are what we call a lagging indicator.
So they look backward.
Exactly. They are looking in the rearview mirror.
Yeah.
So right now in 2026, many homeowners are getting assessments that reflect those peak pandemic values, even though the market in their specific neighborhood might have cooled off.
A lot. So you might be paying taxes on a phantom value that doesn't really exist anymore.
Precisely. And because local governments are dealing with inflation, higher costs for everything, they have every incentive to keep those valuations high.
Well, our mission today is pretty simple. We're going to demystify this whole process. I know the word appeal sounds scary. It sounds like you need a lawyer or a suit.
Or degree in municipal finance.
Yeah, but looking at these sources, it really seems like a cheat code for homeownership that almost nobody is using.
It is absolutely a form of financial literacy. In a post-pandemic economy where every dollar counts, you just can't afford to be passive about your biggest expense. And to be clear, unless you have a commercial building or some mega mansion, you usually don't need a lawyer for this. You just need to be organized.
Okay, so let's unpack this. Before we get into the how-to, because we have a literal step-by-step guide to go through, we need to understand the mechanics. What are we actually fighting when we open that envelope?
Right. When you look at that tax bill, it looks like a jumble of numbers, millage rates, levies. But you really only need to care about two variables. First, there's the tax rate. And second, there's the assessed value.
And we can only fight one of those, right?
Correct. The tax rate is the percentage the county or city needs to collect to pay for schools, roads, police. You can't appeal that. You're stuck with the rate unless you, run for city council. But the assessed value, that is just the county's opinion of what your house is worth. And opinions can be wrong.
That is the variable we can change. But I want to flag something really important from our source material here. There's this special note about something called the discount trap. This felt like a real gotcha moment waiting to happen.
Oh, this is crucial. Before you go through all the trouble of appealing, you need to understand how your specific county assesses property. The author of one of our articles, they shared a story where they found out their home was assessed at 85% of its market value.
Which sounds great, right? If Zillow says my house is worth 500 grand and the tax man says it's worth 425, I should just keep my mouth shut.
You'd think so. But that is the trap. In many jurisdictions, this assessment ratio is set below 100% on purpose. So if the standard for your county is to assess homes at 80% of market value, but you're at 85%, you are actually being overtaxed, even though the number looks low.
That is incredibly sneaky. It relies on you not knowing the math.
It does. So the first step isn't filing paperwork. It's just checking the equalization rate or assessment ratio for your area. If everyone else is getting a 20% discount and you're only getting 10%, you're subsidizing your neighbors.
Okay, so let's say I've looked at my bill, I've checked the ratio, and the number still just seems high. How do I know if I have a winnable case? The sources give a really helpful checklist here. It's almost like a diagnostic test for your tax bill.
It is. You want to pick battles you can actually win.
The first one is the most obvious one. Purchase price versus assessment.
This is the slam dunk.
Mm-hmm.
If you bought your house recently, let's say in 2024 or 2025, and you paid, say, $400,000, but the county sends you a bill saying it's worth $500,000, you win. The best evidence of market value is what someone actually just paid for it.
You basically just send them the receipt and say you're wrong.
Pretty much. It's really hard for an assessor to argue with a signed closing statement.
But what if I've lived there for 10 years? I can't use my purchase price from 2016.
Then you look at inequity. That's the second point on the checklist.
Mm.
If similar homes in your neighborhood are selling for a lot less than your assessed value, or if your neighbors are assessed lower than you for the exact same house, that's your evidence.
And then there's the hidden damage factor. This is one people forget. The assessor doesn't usually come inside your house, right?
Almost never. They're doing mass appraisals.
Mm.
They are driving by in a van or honestly just using software to guess.
Mm.
They don't know that your foundation is cracked. They don't know a storm damaged your roof last year and you haven't fixed it.
So usually we want our homes to be worth as much as possible. But on tax day, you want your house to be a dump.
Exactly. My castle is actually a hovel. If your house has serious issues that aren't visible from the street, you're probably being overcharged. They're assessing you as if the house is in average or good condition. If it's actually in poor condition, you need to tell them.
That's a huge point. If your basement floods every time it rains, that lowers the value of your home, and your taxes should reflect that.
Exactly. And the last item on that checklist is a bit broader: neighborhood decline. Maybe a big employer left town. Maybe the local amenities have degraded. If the whole area has dropped in value, but the assessor hasn't adjusted downwards, it's time to fight back.
Okay, so let's say I check one of those boxes. I'm ready to fight. What's the very first tactical step? The source calls it the property card hack.
This is my favorite part because it's so low effort but so high reward.
Yeah.
You call the assessor's office or you go online and you ask for your property card or worksheet.
Yeah.
This is the official record of your home's specs.
And we're just looking for clerical errors here.
You are looking for pure mistakes. Does it say you have 3,000 square feet when you only have 2,500? Does it say you have a finished basement when it's just, concrete and spiders? Does it list a fireplace you don't have?
Phantom bathrooms, essentially.
Yes, I've seen it happen. A typo adds a half bath that doesn't exist.
Yeah.
These are the easy wins. You don't have to argue about market trends. You just show them the photo and say, I don't have a deck, and they have to correct it.
I love that. It's just correcting a typo that costs you money every single year. But let's say the property card is actually correct. Now we have to prove the value is wrong. This brings us to the CSI real estate section of the deep dive. We need to gather evidence.
Right. And in 2026, we have tools that make this incredibly easy. You don't need to go dig through filing cabinets at the courthouse. You can use Zillow, Redfin, Realtor.com. But, and this is a big but, you have to use them correctly.
There's a very specific strategy here. You can't just look at what people are asking for their homes.
This is the most common mistake. People look at list price. Oh, my neighbor's asking $600,000, so my house must be worth that. No, I can list my shack for $1 million. It doesn't mean it's worth $1 million. You have to filter by sold.
So we're looking for hard data, actual transactions.
Exactly. An expert tip from the source. A home listed for $400 that sells for $375K is a $375K comp. That's the real market value. You're looking for 3 to 5 comparable sales right in your ZIP code.
And timing matters here too, right? We can't use sales from 3 years ago.
Recency is key. We're looking for sales in the past 6 to 12 months. A sale from 2 months ago is much stronger evidence than a sale from a year ago, especially in a market like we have now. If prices have dipped, you want the newest sales to prove it.
What about seeing what the neighbors pay? Is that public?
It is entirely public. You can go to the county assessor's site and look up your neighbor's tax bill. If you and your neighbor have the exact same model of house built in the same year, and they're assessed at $300K and you're at $350K,
Yeah.
print that out. That is powerful evidence of inequity.
It's the fairness argument. Why am I paying more for the same thing?
Exactly. And boards of appeal, they respond well to fairness arguments.
And then there's the visual evidence. We touched on this with hidden damage. But the source really emphasizes taking photos.
Yes. Don't just tell them the roof is bad. Show them the curling shingles. Show them the water stains on the ceiling. Even better, get a professional estimate.
A quote from a contractor.
Right. If a roofer says it'll cost $20,000 to fix, that's a hard number. You can present that to the board and say, my home's value is reduced by this liability. It turns a subjective complaint into an objective math problem.
And one optional step mentioned is getting a real estate agent involved.
It's not required, but getting a comparative market analysis, or a CMA, from an agent can add a lot of credibility. Agents do this for free all the time, hoping for future business. It just looks more professional than your own scribbles.
Okay, so we've got our comps, we've got our photos of the cracked driveway, we've got our neighbor's tax bill. Now we have to actually file this thing. And here is where the deep dive turns into a bit of a warning. We are on a deadline.
We are. The urgency cannot be overstated. Most jurisdictions have deadlines between January and March. Since it's mid-February right now, for many listeners, that window is closing. You usually have about 30 days from the moment that notice hits your mailbox.
So this isn't something you can put in the to-do later pile. If you snooze, you lose.
Literally, if you miss that deadline, you are locked in for another whole year. You can't appeal until the next cycle.
And is it free to do this?
Usually not. There's typically a filing fee. It can range from, say, $30 to maybe $150, depending on where you live.
Which feels annoying, honestly. Paying money to tell them they charged you too much money.
It is annoying, but you have to frame it as an investment. If you pay $50 to save $500 a year, well, that's a pretty good return.
True. Now, most of this is online, but let's talk about the hearing. Sometimes you just mail it in, but sometimes you have to actually go in person or do a Zoom call. What's the behavioral advice here?
This is critical. Do not, I repeat, do not go in there and rant about the government or how taxation is theft or anything like that.
So leave the soapbox at home.
Please. The people on the review board are just regular folks doing a job. They don't control the tax rate. They're just looking at the math of your home's value. Keep it factual. Here are 3 sales that show my value is lower. Here's a photo of my broken foundation. Therefore, my assessment should be X.
Be the boring, polite accountant.
Exactly. Emotion doesn't win tax appeals. Data does.
Yeah?
If you start yelling about politics, they just tune you out. If you show them a spreadsheet, they listen.
That makes perfect sense. Now, I want to pivot to a section that targets a very specific demographic. Our listeners who are age 60 or older. Or if you're younger, maybe this is for your parents.
Yes, this is a huge area of opportunity that gets missed all the time. If you're a senior, you might not even need to appeal your value. There are programs designed specifically to lower your bill just based on your age.
Let's run through some of the examples they give.
Okay, so you have exemptions. These just reduce the taxable value of your home. The source lists Texas, Florida, Georgia, Colorado. They have strong exemption programs for seniors. It basically just knocks a chunk of value off the top.
And then there are freezes. This sounds like the best deal of all.
It is massive.
Ugh.
A freeze locks in your home's valuation. So even if the market goes crazy, your tax assessment stays frozen at the level it was when you signed up. The source highlights Illinois, Arizona, New Jersey for these kinds of freezes.
That's incredible for fixed income planning. You don't have to worry about being taxed out of your home.
Absolutely. And then there are credits, like in Montana, which provide refunds if your taxes go over a certain percentage of your income. The key takeaway for all of this is these programs are almost never automatic.
They don't just give it to you when you turn 65.
No, you have to ask. If you're over 60, just pick up the phone and call your local tax authority. Ask specifically, what senior relief programs do you have? It's like asking for the senior discount, but instead of saving $2 on coffee, you might save $2,000 on taxes.
Okay, we've talked about DIYing this, but when should we call in the cavalry? When do we hire a pro?
Sometimes the DIY route isn't enough. If you lose your appeal and you're just convinced you're right, or if the stakes are really high, the source suggests hiring a property tax consultant or a real estate attorney if you have a high-value property, a very unique home, or if the dispute amount is significant.
And how do they get paid? I mean, I don't want to pay a lawyer $300 an hour to fight a $500 tax bill. The math doesn't work.
No, and that's the beauty of this industry. They almost always work on contingency. They take a percentage of the savings.
So if they don't win, you don't pay.
Correct. Typically, they take 30 to 50% of the first year's savings, so it's risk-free for you. They save you $1,000, you pay them maybe $400, and you pocket the $600 plus you keep all the savings in the future.
That seems like a pretty good deal if you don't have the time or the confidence to do it yourself.
It is. Just make sure they're licensed and check their reviews. It turns a headache into a hands-off process.
All right, we're coming down to the wire here. We need to talk about the risks and rewards. We've hinted at the savings, but let's do the math. What is the ROI on this?
One of the sources breaks it down really simply. If you're overpaying by just $500 a year, which isn't a huge amount, that's $5,000 over a decade.
That's a new roof. That's an emergency fund. That's a really nice vacation.
Exactly. And the time investment to do this is maybe 1 or 2 hours. So if you spend 2 hours to save $5,000, Your hourly wage for that work is $2,500.
When you put it that way, it's insane not to do it.
But we have to mention the backfire risk. It is rare, but the source material is clear that an assessment can increase.
This is the nightmare scenario. You ask them to look at your house and they find something valuable you didn't tell them about.
Right. The classic example is the undeclared in-ground swimming pool.
Yeah.
If the assessor comes out to review your appeal and sees a pool or a finished garage or a new addition that wasn't on the books, they are going to add that value.
So, rule of thumb, if you have illegal improvements or unpermitted upgrades, maybe don't invite the assessor over.
Correct. Do your research first, audit yourself before you ask them to audit you. But for the vast majority of people, the 99% who haven't built a secret bunker in the backyard, the outcome is binary.
Yeah.
Either you win and save money, or you lose and things stay the same. No harm, no foul.
Win-win, or at least win-draw.
Exactly.
So what does this all mean for us?
It means that the property tax system relies really heavily on homeowner apathy. It relies on the fact that 95% of people will just write the check because they're busy or intimidated, or they just assume the government is right. The system is designed to be just complicated enough to discourage you, but as we've seen, it's actually quite brittle.
It's a paper tiger.
It is. A little bit of pressure, a few comps, a photo of a crack in the wall, and the numbers often crumble in your favor. You just have to be willing to push.
I love that. So here is your final call to action. The episode is ending. Do not just move on to the next podcast. Open a new tab. Google your county name property assessor. Just look at your property card. That's step one.
Just one click. Check the square footage. Check the bathroom count. It's the first step to potentially keeping thousands of dollars in your own pocket.
And I want to leave you with a provocative thought to chew on. We talked about how these assessments are often done by algorithms that have never seen the inside of your house.
Mass appraisal.
Right. So if property taxes are the bedrock of local economies, funding our schools, our roads, but those taxes are based on a phantom value determined by a computer that doesn't know your roof is leaking, how much of our local economy is funded by money that technically doesn't actually exist?
That is a fascinating question.
And why is the burden of proof on you to correct their math? It feels like the entire system is upside down.
It shifts the responsibility entirely onto the citizen to audit the government. It's a strange social contract.
It certainly is. Something to think about while you're searching for those comps. Thanks for diving in with us.
See you next time.